So Donald Trump just handed Canada an $875 billion ultimatum, a 25-year energy supply contract that would lock Canadian oil into below-market pricing for an entire generation, funneling nearly $1 trillion in discounted crude to American refineries. And Mark Carney shut it down in under 48 hours. But he didn't just say no. What he revealed about where that $875 billion number actually comes from is going to change how you think about every single barrel of Canadian oil that has ever crossed the American border. And Warren Buffett's response is unlike anything he's ever said publicly about the energy industry. When you hear what the Oracle of Omaha called this ultimatum, you'll understand why this story isn't about trade. It's about the biggest transfer of wealth between two allied nations in modern history. Hit subscribe right now because the numbers in this story will change how you see everything. Let me fill you in on what just happened behind closed doors. 2 weeks ago, the United States Trade Representative's office delivered a confidential document to the Canadian Embassy in Washington. It was 147 pages long, bound in a gray cover stamped classified, not for public distribution, entitled The North American Energy Security Framework. The document had been in preparation for months. It was drafted by a team of energy policy advisors, trade lawyers, and Pentagon consultants, and it represented the most comprehensive energy demand the United States has ever made of any allied nation. A senior Canadian diplomatic source who reviewed the document leaked its existence to the Globe and Mail, calling it the most predatory document I've seen in 30 years of government service. Here's what the document demanded. Now, Canada would sign a 25-year binding energy supply agreement committing to provide a minimum of 8 million barrels of crude oil per day to American refineries. That volume represents approximately 88% of Canada's total daily production, leaving almost nothing for diversification. The price would be locked at West Texas Intermediate, $1.14 per barrel, a structural discount significantly below global market rates for the full 25-year term. To put that in perspective, WTI minus 14 means that if global oil trades at $80 per barrel, American refineries would be contractually guaranteed to buy Canadian crude at 60 cents. If oil goes to 100, they'd pay 86 cents. If oil goes to 120, they'd pay 106. The discount is permanent regardless of market conditions. It's a one-way subsidy that only benefits the buyer. Canada would be contractually prohibited from diverting more than 15% of its total oil exports to non-American markets, effectively capping its ability to sell to Asia, Europe, India, or anyone else. This provision is the most insidious clause in the entire document because it legally prevents Canada from building the very export diversification that would give it leverage to negotiate better prices. It locks in the monopsony. It makes the captive market permanent. American pipeline companies would be granted guaranteed access to Canadian territory for pipeline maintenance, expansion, and new construction with an expedited permitting process that bypasses Canadian environmental review. And the penalty clauses for non-compliance included $50 billion in escalating trade sanctions over 10 years, plus the automatic reimposition of all suspended tariffs. In exchange, Trump would pause current tariff escalations and guarantee continued pipeline access for Canadian oil. The guarantee, it should be noted, was contingent on Canada's compliance with every other term of the agreement. In other words, give us your oil at a discount for a generation, or we shut off the only way you have to sell it, and if you agree but later try to change the terms, we'll sanction you into submission. This wasn't a trade deal. This was an indenture contract. It was designed to ensure that Canada's primary natural resource, the backbone of its export economy, would be sold at below market prices to a single buyer for 25 years. And the math on what that contract was worth is staggering. Energy economists ran the numbers the day the document leaked. 8 million barrels per day discounted at $14 below global benchmark, 365 days a year for 25 years. The total value of the discount, approximately $875 billion in revenue that Canadian workers, Canadian communities, and Canadian governments would never see transferred instead to American refinery balance sheets, American gasoline prices, and American shareholders. Let that number sit for a moment. $875 billion. That's more than the entire GDP of Saudi Arabia. It's more than the annual federal budgets of Canada, Australia, and the Netherlands combined. And Trump's team reportedly believed Canada had no choice but to sign because 97% of Canadian oil flows through American-controlled pipeline infrastructure. Now, this is where it gets wild. Carney received the document on a Monday. By Tuesday evening, he had assembled a team of energy economists, trade lawyers, and the deputy ministers of finance, natural resources, and foreign affairs in a secure briefing room in the Langen block. By Wednesday afternoon, his team had completed their counter-analysis, And by Friday morning, less than 48 hours after the analysis was finished, Mark Carney walked onto a stage at Parliament Hill in Ottawa, faced a wall of national media cameras, and delivered a 22-minute address without a single note in front of him. He didn't just reject the ultimatum, he declassified it. On live national television, Carney began reading key clauses from the leaked document aloud, word by word. The $14 discount, the 15% export cap, the $50 billion penalty clause, the 25-year binding term. He read each provision slowly, clearly, and without editorial commentary, letting the words speak for themselves. It was an act of diplomatic defiance that has no modern precedent. A sitting prime minister reading a classified foreign government document to his own citizens on live television, daring the country that sent it to object. And then he delivered the lines that will define his legacy. He called the agreement a colonial-era extraction contract dressed up in trade language. He said this document treats Canada not as a partner, not as an ally, not as a sovereign nation, but as a resource colony whose primary function is to provide cheap energy to another country's economy. And then he said the line that sent the entire country to its feet. No Canadian Prime Minister will ever sign a document that turns this country into a discount gas station for another nation. Not today, not in 25 years, not ever. Carney then announced 3 immediate actions in response to the ultimatum. First, the formal diplomatic rejection. The official response to the North American Energy Security Framework was delivered by hand to the U.S. Embassy in Ottawa within the hour. The covering letter, which was also released to the public, stated that Canada categorically rejects any framework that seeks to impose long-term pricing constraints on Canadian sovereign resources. Second, the acceleration of the Canadian Energy Sovereignty Corridor. Carney announced that CSC's construction timeline was being compressed from 24 months to 16 months, with an additional $85 million in emergency federal funding allocated to fast-track the Pacific Pipeline extension and Atlantic port upgrades. He said, not only are we rejecting your ultimatum, we are building the infrastructure to make sure you never have the leverage to issue one again. Third, and most significantly, the pricing announcement. Beginning in the third quarter, a portion of Canadian oil exports would be sold at Brent-linked global benchmark prices rather than WTI-linked American prices through the CSC digital trading platform. Canadian producers were expected to earn an additional $6 to $14 per barrel on every unit sold through the platform. And for the first time in decades, Canadian oil would be priced for the global market, not for American refineries. The reaction in Parliament was something that Canadian political observers said they had never witnessed. A standing ovation that included not just the governing party, but the opposition Conservative leader, the NDP leader, and the Bloc Québécois. In a country where partisan division is the default setting of political life, the rejection of the ultimatum produced a moment of unanimous national solidarity. A Snap poll conducted that evening showed 84% of Canadians approved of Carney's rejection. The phrase, "not a discount gas station," was trending #1 on every social media platform in Canada within minutes. Carney didn't just reject a deal, he gave Canada a rallying cry. But here's where the story turns. Because Carney didn't just reject the $875 billion figure, he weaponized it. In the second half of his address, Carney revealed that the Department of Finance had conducted a 20-year retrospective analysis of the price differential between Western Canadian Select, the benchmark for Canadian heavy crude, and global oil prices. Since 2005, WCS has traded at an average discount of $15 to $18 per barrel below the Brent global benchmark. This discount exists not because Canadian oil is lower quality, although it does require specialized refining, but primarily because Canada has had only one pipeline-connected customer, the United States. When you have one buyer and no alternative route to market, the buyer sets the price. That's not economics. That's leverage. Over 20 years at average export volumes of 5 million barrels per day, the cumulative value of that discount came to approximately $890 billion. Let me say that again, $890 billion. Trump demanded $875 billion in future discounts, but Canada has already given America nearly $900 billion in past discounts. The numbers are almost identical, and that's not a coincidence. And Carney looked directly into the camera and said, "The ultimatum we received last week asks us to lock in a discount for the next 25 years. What the authors of that document didn't expect was that we would calculate what that same discount has already cost us over the past 20 years. The answer is $890 billion. This ultimatum wasn't a new demand. It was an attempt to formalize an exploitation that has been happening unchallenged for 2 decades. He then presented data showing that American refineries, specifically Marathon Petroleum, Phillips 66 and Bolero have earned an estimated $35 billion in annual windfall profits from processing Canadian crude purchased at structurally suppressed prices. He named the companies. He cited their annual reports. He showed the margin differential between what they paid for Canadian crude and what they earned selling refined products at global market prices. And he said, these companies have built their profit models on Canadian generosity. That generosity is over. The reframe was devastating. Every viewer who had entered the story thinking it was about an ultimatum being rejected now understood that the real story was about a generation of wealth extraction being exposed. This wasn't Canada saying no to a bad deal. This was Canada revealing that the bad deal had been running silently for 20 years. This isn't a trade relationship. This is a wealth extraction system. And the $875 billion ultimatum was just the first time anyone wrote the number down. And then came the response that elevated this from an energy story to a global financial event. Warren Buffett's statement arrived within 6 hours of Carney's press conference. In a response released through Berkshire Hathaway's investor relations page, the 94-year-old billionaire delivered an analysis that validated everything Carney had revealed and went further. He said, "What Prime Minister Carney revealed today isn't new to anyone who understands energy economics. The pricing disadvantage Canada has accepted for decades is the largest sustained wealth transfer between allied nations since the Marshall Plan. Except in this case, it's going in the wrong direction." And then he said, $875 billion to lock in a below-market price for 25 years. In my business, we have a word for that. We call it a steal. And I don't mean a good deal. And then this isn't about politics. It's about math. And the math says Canada's been subsidizing American gasoline prices with its own resources for a generation. I need you to understand why Buffett's voice is uniquely devastating in this context. Berkshire Hathaway's energy subsidiary, BHE, operates pipelines, power plants, and utilities across North America. Berkshire owns natural gas distribution networks that serve millions of American homes. Buffett profits from American energy infrastructure. His critique isn't coming from an outsider or a political opponent. It's coming from inside the industry, from a man whose own balance sheet benefits from the very system he's calling exploitative. When the man who profits from American energy tells you the pricing structure is unfair, there's no credible counterargument left. The defense rests. Buffett has a documented track record of calling out predatory business practices when he sees them, even when doing so damages his own interests or his own industry. He forced out the leadership of Salomon Brothers in 1991 when he discovered trading fraud. He publicly criticized Wells Fargo in 2016 despite being its largest shareholder. He wrote down billions on Kraft Heinz in 2019 and admitted the acquisition had been a mistake. He doesn't call things a steal lightly. He built his fortune on recognizing when something is priced wrong and acting on it before anyone else. And he just told the world that Canadian oil has been priced wrong for 20 years, that the mispricing is deliberate, and that the correction is now underway. And then Buffett revealed something that changed the entire conversation. Berkshire Hathaway's most recent SEC filings show that the company has been building positions in Canadian energy producers for 18 months. Berkshire recently acquired significant stakes in Suncor Energy, Canadian Natural Resources, and Cenovus Energy, Canada's 3 largest oil sands producers. These are companies whose stock prices have been depressed for years precisely because the WCS discount suppresses their revenue. Berkshire has also been investing in Trans Mountain pipeline capacity and Pacific Coast terminal expansion, the exact infrastructure that will carry Canadian oil to global markets at global prices. The investment thesis is elegant and obvious once you see it. Buy undervalued Canadian energy companies. Wait for the pricing structure to correct as Canada builds alternative export routes, and watch the stock prices re-prick upward by 30 to 40% as Canadian crude converges with global benchmarks. Buffett isn't just criticizing the ultimatum. He's betting 9 figures that Canadian oil will trade at global prices within 3 years, and he's structured his portfolio to profit when it does. An anonymous Berkshire board member told the Wall Street Journal, Warren has said privately that Canadian energy is the most undervalued asset class in the Western world, and it's undervalued for one reason: American pricing control. Remove that control and Canadian energy reprices by 30 to 40%. That's not speculation, that's arithmetic. Think about that for a moment. The most successful investor in history is buying Canadian oil companies because he believes they have been systematically underpriced by American market structures for 2 decades. That's not a hedge, that's a conviction. And when Buffett has a conviction, the market follows. If Buffett says Canadian oil is undervalued because of American pricing manipulation, the repricing has already begun, and the market confirmed it within hours. Canadian energy stocks surged on the day of Carney's press conference. Suncor jumped 9%, its largest single-day gain since 2020. Canadian Natural Resources rose 11%. Cybus climbed 8%. Imperial Oil, majority owned by ExxonMobil, but with significant Canadian operations, rose 6% as traders priced in the expectation that all Canadian producers would benefit from the pricing shift. The Toronto Stock Exchange hit an all-time closing high, driven almost entirely by the energy sector, with the S&P/TSX Energy Index posting its best session in over 3 years. Meanwhile, American refinery stocks cratered. Marathon Petroleum fell 7%, wiping out roughly $4 billion in market capitalization. Phillips 66 dropped 6%. Valero lost 5%. Holly Frontier, a Midwest refiner heavily dependent on Canadian heavy crude, fell 2%. The logic was simple and brutal. Every dollar of pricing advantage that Canadian crude moves toward global benchmarks is a dollar that comes directly off American refinery margins. The WCS-WTI spread, the pricing differential that represents the exploitation mechanism itself, immediately narrowed from $17 to $12 as traders began pricing in the expectation that Canadian oil would increasingly trade at global benchmarks rather than American discounted rates. $5 of spread closure in a single session is extraordinary. The Canadian dollar strengthened 2% against the greenback, its largest single-day gain in 14 months. The market is repricing Canadian energy in real time. The exploitation discount is collapsing, and every trader on every energy desk in the world is running the same calculation. What are Canadian energy companies worth when their oil sells at global prices instead of captive prices? The answer, according to Goldman Sachs, is 30 to 45% more than current valuations. The political fallout in Washington was equally chaotic. The White House was furious, not primarily about the rejection itself, but about the fact that the classified document had been leaked and then read aloud on national television. The press secretary called Carney's address a theatrical stunt designed to damage bilateral relations and demanded that Canada return all copies of the document. That demand was met with widespread mockery, given that the document had already been broadcast to millions of viewers. Trump posted 11 times on Truth Social over a 4-hour span, calling Carney ungrateful, disloyal, and a failed banker who doesn't understand real deals, and threatening total energy war without specifying what that meant. Each post was angrier and less coherent than the last, creating the impression of a leader in escalating panic rather than one in control. The Republican caucus fractured along familiar lines. Trade hawks backed Trump and called for retaliatory measures, but energy state senators from Alaska, North Dakota, Texas, Wyoming, and Montana were horrified. Their refineries depend on Canadian crude. Their constituents work in industries that process Canadian oil. Retaliating against Canada would directly harm the voters who sent them to Washington. One Republican senator from an energy-producing state told CNN, "That document should never have been written. It reads like something from the 1890s. No ally should be presented with terms like that." And the fact that someone in this administration thought it was appropriate tells you everything about how badly we've lost the plot. Democrats introduced a resolution condemning the ultimatum as inconsistent with American values of fair trade between sovereign partners. The resolution was symbolic, but the bipartisan criticism told you that even Washington knew the document was indefensible. You cannot defend a 147-page contract that demands a 25-year below-market lockup from your closest ally. The terms speak for themselves, and now the whole world has read them. In Canada, the political consolidation was total and unprecedented. The opposition Conservative leader who has built his entire political career on opposing Carney and has called him everything from out of touch to an elitist central banker playing at politics publicly endorsed the rejection. It was the first time he has endorsed any Carney policy since taking office. He told the CBC, "This isn't a liberal policy or a conservative policy. This is a Canadian policy." And any prime minister who didn't reject those terms would be committing economic treason. The Premier of Alberta, a conservative who has clashed with Carney on carbon policy, pipeline regulation, equalization payments, and federal spending, went on television and said, "I have disagreed with this prime minister on almost everything. Today, he speaks for all of us." The NDP leader called the ultimatum proof that American trade policy is driven by extraction, not partnership. The Bloc Québécois leader, who rarely comments on energy policy, issued a statement calling the rejection a defense of Quebec sovereignty, as much as Canadian sovereignty, not a discount gas station, became an unofficial national slogan overnight. Within 48 hours, the phrase appeared on t-shirts, bumper stickers, social media banners, and handmade protest signs at Canadian border crossings from Windsor, Ontario to Surrey, British Columbia. A follow-up poll conducted 3 days after the press conference showed 87% approval for the rejection, the highest approval rating for any single policy action in the history of Canadian opinion polling. Carney didn't just reject a deal. He gave Canada a rallying cry. And he gave every energy-producing province in the country a reason to support the federal government for the first time in a generation. Now, let me explain the economics behind all of this, because once you understand how the discount actually works, you'll never look at a barrel of Canadian oil the same way again. Canadian heavy crude, known as Western Canadian Select or WCS, is chemically different from American light crude, known as West Texas Intermediate or WTI. It's heavier, more viscous, and contains more sulfur. Processing it requires specialized refinery equipment called cokers and hydrocrackers that not every refinery has. The refineries that can process it are concentrated almost entirely in the American Midwest, centered around the Cushing, Oklahoma storage hub. And because virtually all of Canada's oil export pipelines run south to those same refineries, Canada historically had one route to one customer. Imagine you grow the best apples in the world, but there's only one road leading out of your orchard, and it goes to a single market. The owner of that market knows you have no alternative buyer. He knows your apples will rot if you don't sell them. So he pays whatever price he wants, and you accept it because the alternative is watching your harvest go to waste. That's not a free market. That's a monopsony, a market with one buyer. And it's the textbook definition of structural price exploitation. Every first-year economics student learns that monopsonies produce prices below what a competitive market would, and the Canadian oil market has been the world's largest functioning monopson for over 2 decades. The scale of the distortion is staggering. Over the past 20 years, WCS has traded at an average discount of $15 to $18 per barrel below Brent, the global benchmark that reflects what oil is actually worth when sold in a competitive market with multiple buyers. But here's the part that almost nobody talks about. The actual legitimate cost differential for refining heavy crude versus light crude is only $4 to $6 per barrel. That's the real discount, the one that reflects genuine processing costs. The remaining $9 to $14 per barrel is pure market power. It's the premium that American refineries extract simply because they can, because Canada has no alternative route to market, because the pipelines run south and only south. American refineries aren't paying less for Canadian oil because it's worth less. They're paying less because they can. And over 20 years, that excess discount, the portion above and beyond legitimate processing costs, has transferred somewhere between $540 billion and $890 billion from Canadian producers to American refinery shareholders. That's not a pricing mechanism. That's a toll booth on someone else's highway. Now consider what happens when Canadian oil trades at global prices through the CSC digital platform. Canadian producers earn an additional $22 to $30 billion per year in revenue. That's not a projection based on optimistic assumptions. That's the simple result of selling the same product to a global market instead of a captive one. Canadian government tax receipts increase by $6 to $8 billion annually because higher revenue means higher royalties, higher corporate taxes, and higher income taxes from better paid energy workers. To put those numbers in human terms, $6 to $8 billion annually is enough to fund universal pharmacare for every Canadian citizen, something the country has been debating for decades. It's enough to eliminate the budget deficits of 3 provinces simultaneously. It's enough to build 200,000 units of affordable housing every single year. The money that has been flowing to American refinery shareholders for 20 years could have been building Canadian hospitals, Canadian schools, and Canadian infrastructure. American refineries, meanwhile, would need to pay fair market value for the crude they've been buying at a structural discount for 2 decades. Their costs would increase by 10 to 14 per barrel. Midwest gasoline prices would be projected to rise by 4 to 65 cents per gallon. That's roughly $500 to $750 more per year for the average American household in the affected region. For decades, American consumers have been enjoying cheap gasoline subsidized by Canadian oil workers who were being paid below market prices for their labor and their resources. That subsidy was invisible. Nobody in Michigan or Ohio or Illinois knew that part of the reason their gas was cheap was that Canadian oil was being systematically underpriced. Now they know, and the subsidy is ending. And Buffett captured the dynamic with a line that will be studied in economics textbooks for decades. When an unfair price corrects, the people who benefited from it call it a crisis. The people who were exploited call it justice. Now let me tell you what this means at the broadest possible scale. This is the first time in modern history that a major oil exporting nation has publicly quantified, documented, and rejected a below-market pricing structure imposed by its primary buyer. Other nations are in similar positions. Norway has long questioned whether Brent pricing is subject to speculative manipulation that costs Norwegian producers billions annually. OPEC nations have debated dollar dependency for decades and have been experimenting with alternative settlement currencies. Australia faces analogous dynamics with critical mineral exports, where processing bottlenecks controlled by China and the United States suppress the prices Australian miners receive. Brazil's state oil company Petro has complained for years that infrastructure constraints force it to sell crude at discounts that don't reflect true market value.